So what is the timing around which we can expect the shorts to actually get knocked out, like completely knocked out to the point where they are forced and they have their back against the wall? I mean, don't get me wrong. They currently have their back against the wall, but I don't think it's at that line where it's like game over, So I did a little bit of the math, I crunched numbers a little bit. I mean, and I'm going to show you that on this video in a second, to where we can expect to see that, the covering process to kick off. Like, okay, they will be like, man, we can't do this anymore. They like, hands off. They won the game. Like we thought they were gonna be out of this after 3 months, but after 9 months, after so far 9 months, they are still in there and they are more coming into the play. Like, we don't want to fight for bankruptcy. We don't want to end up having to pay back the money for clients that we lost on AMC play. A single play. I mean, not a single play, because it's AMC and GameStop and Coast and multiple others. So let me share with you what is my thought process as we move forward on this. So I brought up the calculator, but before going into the numbers, let me go back to the chart, because as you can see, AMC hit the 77 pre-market on June. And since then, it came back down, boom, hard, like 20%. And after that, it came back up, so actually 30%. The 30%, it came back strong, and we had a little bit of consolidation, but we were making lower lows and lower highs and lower lows. So it brought us back to the low 30s, but since then, we are kind of going back up, and the uptrend looks pretty good so far. Okay, it looks good from a fundamental standpoint, from a technical standpoint, from a option chain. Everything is kind of the rules, and everything is in favor of AMC right now. Well, if things continue this way, because you just never know with this stock and these short sellers, you just never know. But let's just imagine for a second that we continue and we hit the 70s and we break that 70 barrier, because it was kind of boom. Okay, at what point as we move forward do we expect the hedges to be like, oh man, I can't do this anymore, I have to cover? Okay, I white flag. Now we know there are multiple short sellers in this play. It's not only Citadel, and most of the time when we mention Citadel, it's just as a symbol to represent the whole short sellers in this play. But they are not even the biggest one on this. I think Simplex Trading is the biggest one with hundreds of millions of shares short selling AMC. I think Citadel may be sitting on the dozen, but that's what has been officially reported. And we know from the SEC standpoint, you don't have, as long as you're shorting a stock, you don't have to report the right positions. You don't even have to tell them how short you are on AMC. And even if you go to the dark pools, that's when the thing becomes like dark vator thing, okay? Like Thanatos. So let's just take, for the sake of this example, that Citadel is one of the biggest and represent the rest of them. And let's say they are sitting on 100 million shares, all right? Just for the sake of this example. It might be 500, it might be a billion. I don't know, but I wouldn't be surprised if it's the case. Now, right now, AMC is sitting at what? 51. So when it hit 77, nothing happened. By nothing, it didn't go all the way up, because we were coming from 26, all right? Now, let's just imagine we are sitting on a price around 130, okay? 130. Because if they had the ability to short this, to cover at 5, and they let it go because they wanted to like crush the thing, all right? Once we are around 130, okay? 130 minus 5, it's a 125 gap. Like, they are down $125 per share, all right? This considers I mean, this constitutes, let's just divide it, okay? So 130 divided by 5 by 100 is the percentage. They will be down, they will be losing 2600% of their investment, okay? Now, 2600%, remember, we have $125 per share gap. Let's say they're sitting on 100 million shares. So 100 million, 1, 2, 3, 1, 2, 3 times 125. 1, 2, 3, 1, 2, 3, 1, 2, 3. That will be a $12.5 billion. $12.5 billion loss on a single play. And I'm not even counting on this, the amount of interest they have to pay on a daily basis. Because I expect when the share price, skyrockets to, that 130 or $1, without even counting FOMO and everything, the other market circumstances, they will be paying a significant amount increase in interest every single day, because in order to short sell a stock, you have to borrow the stock. And borrowing the stock means you have to pay interest on every single day you are still borrowing that stock. All right. Now, $12.5 billion. How big will this be for a loss of Citadel? Let's go to Citadel AUM, asset under management. This is as of October 2020. This is the amount of money they are managing for their clients. All right. So $35 billion. Let's just take these 12.5 over the $35 billion. That is a 36% lost on the entire asset under management. This is huge, guys. This is huge for a company, for a hedge fund. Now, Citadel might not be the biggest, but they are one of the biggest. So if you're sitting on 35 loss, it means all of the money your clients gave you so far since 2020, you are losing 36% of that money. They could have put it into any other play. They could have put it into any other company and made 36% as a gain, not as a loss. So they could have been 70% above what you're offering. How bad is that for a hedge fund image, hedge fund performance, even though it's Citadel? Now, let's keep in mind that this is just for a company like Citadel. Now, if you take companies who have an asset under management, less money to manage, less money on the books, less capital, less firepower, 20 billion, 10 billion, like ODA Asset Management, for example, they came in here around $30, and so far they are losing 70% of the money, and they are not out yet. So for those guys at $130 mark, they will be like gone. And they're not the only little fish in the play. It will cause a domino effect. And that domino effect might even bring this loss to even higher, to the 36. All right. So I think at that point, the clients will be like, you know what, Kenny boy, this is too much. I've had it. This is enough. Let me get my money back. But I lost 36% of it. Let me recover. And they will be like, you know what? Boop. Let me take my money out. And that might potentially cause a major pullback on Citadel asset under management. I'm just speculating here on what can potentially happen once we head to a specific price point, which at this, for the sake of this example, I took 130. So definitely, losing 2,900% of your money. For a hedge fund, it's totally unacceptable. So I don't think they will let it. I don't think they will let it go easy because of the pride, because it's smart money against dumb money. But I don't also think they can sustain this indefinitely. You know what? Because it costs money to lose money. It costs money to short a stock that is continuously being bought in and out, week in, week out by the so-called dumb money. So they can drag this as far as they want, but it doesn't seem like it's working on their favor to do so. The math doesn't lie. It's simple math, guys.